Welcome back to the Hurdle Rate for the week of August 18th, 2025, episode 23 already. I'm Tim Kotzman. I'm here with Matt Cole, Ben Workman, and Jeff Walton. A lot of noise out in the market. Maybe we should just go right to one of several topics that are hot right now. Maybe I'll pass it over first to Ben Workman for what are the themes and what should people be thinking through when some of these companies are trading below 1 MNAV?
Yeah, it's an interesting spot, and it's one that's only really recently starting to get highlighted out there in the market because now you've got several that are. And before, part of that is because you've got several more companies that are in the market. The second part is that they're all raising capital in a different way, and those transactions are all settling in real time now. But some of them have been around for a while, like Assembler Scientific has been around for a while, and now you're watching them, bounce below 1 times NAV and even a little below 1 times NAV at certain points. And it becomes very interesting because the Bitcoin treasury play, right, when you're making this investment, has always been discussed as a very long-term thesis, right? You're betting on the long-term performance of Bitcoin here. And most of the people that are in the space, see the long-term potential in Bitcoin. They believe in the problem that it solves with monetary debasement and combating inflation. And so they're aligned on the long-term outlook and the long-term thesis of Bitcoin. And then when you turn that to the Bitcoin treasury companies, it seems that we've entered a unique spot where, because you're effectively trading equities, the mindset can shift very quickly. Right. So in equities, people are used to rebalancing their portfolios a lot more, where with Bitcoin holdings, it's been, lock those things away and, sit on them for a decade because they might be worth $1 million or $13 million or pick your projection. And so during these periods like we're seeing right now, right, no doubt over the last couple of weeks, you've seen a lot of capital drain out of the Bitcoin treasury space. You've seen it basically across the board, right? It's just been drawdowns in all the Bitcoin treasury companies. And that's creating this really unique dynamic out there where you do start to see some of these companies that are trading below 1 times NAV, right? And one of them that I work with, Sequans, is one of those ones that's trading below 1 times NAV. And what's very interesting is that, there almost becomes a hyper focus on that in the very short term. Because it's new, it hasn't really needed to be addressed yet, where a company's actually needed to go and defend the net asset value. It's kind of been one of these concepts that's been discussed for a while, but it hasn't really needed to be acted on. And so now that you're starting to see these enter the market, I think it's going to start opening up the discussion around, what do you do to defend the net asset value? How should you evaluate whether a company is in a position to defend that 1 times net asset value? And what does the timing look like for when you should defend your net asset value? And what you start to see is that it's quickly, once you get below 1, right away, that discussion starts to heat up, right? There's always that discussion around, well, now is the time to take action to push it back up above 1. And, my position would be that it's slightly more nuanced than that. And there's a lot of things that you need to take into account. The first one is, if you've got a lot of selling pressure coming into the market around an equity, and that can be because of a transaction that's taken place, if you've just got new shares and new investors that are trading in that equity, you can have sentiment out there in the market that's shifting and people are getting out of the space in general. I think we've got a lot of that happening at the moment. There's a lot of reasons why you can have a lot of sell pressure on an equity. And that opens the question of, when would be the right time for a company to deploy their assets to defend that 1 times multiple to net asset value? And it's an interesting thought process to go through because logically you would look at it and go, the lower the MNAV goes, the more accretive any, say you were using buybacks as your method for how you were going to defend it. Well, the lower the MNAV goes, the more shares you're going to be able to pull out of the market with whichever capital it is that you're going to deploy. And so, there's reasons not to have knee-jerk reactions around trading below 1 times NAV. I don't believe trading below 1 times NAV is like the kiss of death in the Bitcoin treasury space. I think that it's a phenomenon that you're going to see with several companies throughout this entire strategy. These valuations are going to ebb and flow, and the sentiment in the market's going to be a huge driver around these. But the other thing you need to consider is you need to look at, what's going around all the individual equities. So there was the one, it used to be Volcon. I think now it's Emperor Digital. They're trading below NAV. I think they're at like a 0.76 NAV at the moment right now as well. So you look at two of them, Sequans and Empery, they both just had capital raises. So you have a huge amount of new shares that enter the market. And once investors have their shares, it's up to them what they're going to do with those shares. Some are going to hold them, some are going to sell them. So you've got this, sustained selling pressure that can come into the market because of the introduction of all those new shares. Some investors aren't going to stay along for the ride, even if you'd like them to be very long term. And so you've got that in the early days where you've got to look through and see, how many of these shares are going to trade hands over what period of time. And as a part of that, I think there's some considerations around when do you act, right? Do you act in the middle of that, or do you act when it seems like the selling pressure has subsided on that equity? The other thing that's popped out there is there's been a lot of people discussing, well, should you sell your Bitcoin to defend your NAV? And I am not a huge proponent of that right now. I mean, Matt made a point before. He says, when you're in the digital gold rush, should you offload the gold? And, I would agree. I think right now you're in the accumulation phase of these. So for the companies that have assets, if they need to deploy them to defend, and it's not just temporary pullbacks and temporary market action, I think you have to really think hard before you would take any actions that impact the actual Bitcoin holdings. Because I think that sends a pretty distinct message out there into the market about your thesis around Bitcoin. Now, there may be drastic times where you might see a company do that. I'm sure at some point you will. But I think right now, while you're just reacting to, day-to-day shifts in the market here around Bitcoin and the Bitcoin treasury companies, I think that's something that most of these companies should avoid in the near term. I don't think that any of these companies should want to be selling the Bitcoin that they just work so hard to defend. So it becomes a very interesting conversation. I'll be curious to hear, Jeff and Matt and Tim, your takes on this topic, because it's one that's been out there conceptually, strategy, put guidance around it. They were going to issue credit instruments to be able to buy back their common stock below 1 times NAV. And I think that this is going to be one of those topics that becomes very unique to the standing of each individual company, because a lot of it's going to depend on what assets do those companies have at their disposal, which is going to determine what options they even have to be able to defend being below 1 times NAV. And I think it's going to be an interesting topic for investors to look at as they're evaluating these companies. Is you always get excited and pay attention to a lot of these Bitcoin treasury companies while the market's ripping, right? That's when the fan bases start to get built, and then things pull back and you start to see a very different tone out there in the market. And I think we're definitely seeing that today. And we'll talk about strategy announcement that seemed to kind of tip that over here today. But it does just, it leads you to have to consider a lot of different outcomes when they start to become realities and they're not just conceptual. So, Jeff, I'd be curious what your perspective is on this.
Yeah. And one of the big topics is this concept of strategy updating their guidance today of below 2.5 MNAV. They added this little piece at the end. Strategy will tactically issue MSTR to pay interest on debt obligations, which is the same, fund preferred equity dividends, and then this third piece, when otherwise deemed advantageous to the company. So it's updating this guidance under 2.5 MNAV and above 1 MNAV. So it's getting to this conversation of the broader MNAV discussion. Ben, you hit very well on the below 1 MNAV and what's going to happen there. And I think there's a lot of noise, particularly today, about this under 2.5 MNAV, which is really just introduced another layer of uncertainty for anybody that's buying directionally any of these instruments. I think the people that are particularly frustrated are options buyers who are leaning into some certainty that they can expect the price to do something in a certain direction until a certain threshold was hit. So they've introduced the updated guidance today, introduced this new element of uncertainty that is difficult for people to analyze. And I think it's frustrated a lot of people after, 2 weeks ago, having guidance that they wouldn't use the ATM below 2.5. So yeah, this concept is really interesting. I think one of the reasons this is a really big topic right now is because the traditional financial market is putting a lot of energy to short these things to 1 MNAV because their underlying thesis is that these things should trade at 1 MNAV. And they're seeing all of these Bitcoin treasury companies pop up, and they're identifying opportunity to effectively just lay on them with capital and shake people out. And I think at some point, this industry becomes too big where traditional financial markets won't be able to kind of lay on them and tamp it down with short capital or short thesis, trying to move it in any one direction. So, yeah, at the end of the day, the Bitcoin itself is capital, and you can go access different capital markets to put on leverage in different ways that you can still go buy Bitcoin, assuming, you've got operations, you could pay the debt obligations or, whatever that may be. You can get creative in different marketplaces, even if it's on a small scale. You could start to leverage your collateral in yield. You can go, stake it in different ways and start yielding on your Bitcoin in different ways. So there's solutions even for these smaller companies that hold this capital, and that's continuing to evolve.
This strikes me a lot as short-term thinking in a similar way that if every time a Bitcoin treasury company traded at 1.1 or 1.2 times MNAV, there was this push to just issue common equity as fast as possible because you're trading above 1 MNAV. That to me is pretty much the equivalent of buyback shares because you're trading at a 0.9 MNAV or something like that. It's short-termism. I think as an equity holder, as senior management, executive management of one of these Bitcoin treasury companies, you need to be thinking over the long run. And what is the long run? Well, in my view, we have a 10 to 15 year period of a digital gold rush. And in a digital gold rush, you want to accumulate as much Bitcoin as possible during that time period. And so if you're thinking in terms of a quarter, which typically in standard markets, you see executives get hammered when they think about just one quarter. They want people to be thinking in years. But in this space, because of the volatility, there are a subset of investors, and I don't think it's the majority of investors, to be clear, but a subset of investors that do think more in the short term. Option traders, people that put very short-term trades on, that are betting on the direction, the size, and the time in a very short period of time. They need something to happen, and they need something to happen now. Well, if you think about how an intelligent Bitcoin treasury company is designed, you're putting on an intelligent leverage. If you think about these perpetual preferred equity instruments, you never have to pay back the capital. It's a perpetual instrument. You're betting on a long-term thesis. And so you don't unwind a long-term thesis because you've seen 1 month seems to be traded at a discount. If you saw it, to Ben's point, if you saw it to go a super deep discount that was persisting for time, well, that might be an interesting opportunity to consider buying back some shares in a way that's really accretive, but it's okay at times to wait. Like that, waiting for a little bit is not a bad scenario. And I think this also gets back to me of, there's a lot of, I would say, angst just in the broader Bitcoin ecosystem, even beyond just Bitcoin treasury. And I think it's because we're not in as much of a bull market yet as people think. There's the Bitcoin gold chart. And I think the Bitcoin gold chart's really interesting. I'm going to pop this up real quick, because if you actually look at the Bitcoin gold chart from 2021 to now, we have not broken above all-time highs. If you actually look when we kind of flirted with it, it was late 2024, right when you saw peak hype in the MicroStrategy trade. So I think what you were seeing in that time frame at the end of last year was the expectation that we were entering a significant bull market in Bitcoin relative to other commodities, and the market got a little heated and then it sold off. And now we're kind of flirting with that high again, but we haven't broken out. So I think there's a lot of questions. Anytime Bitcoin sells up at all, is it a bear market? Is the top end? I don't think that is the case, but a prediction that I'll make is if Bitcoin breaks out above all-time highs relative to gold and sustains here, I think you're going to start to see levered exposure to Bitcoin also break out, because what is that about? It's about greed. I think right now you're seeing fear, and markets operate in fear and greed. And once you see that greed step in, companies, Bitcoin treasury companies that actually have forms of intelligent leverage on, I think are going to start doing really well. And we are in this digital gold rush. And I think that's the thesis, and that's the conviction that you're actually paying and want your executives in these companies to have.
Yeah, it reminds me of several years ago. I jumped in the car and went to a lunch with a prospective investor for a long close-ended fund, long Bitcoin only close-ended fund that I was raising for. And I said, hey, we're in the oil and gas space. That's my background. We have this long only, we're going to hold for 8 to 10 years. And that's the thesis. And the person on the other side of the table said, oh, I talked to someone, they had a bad experience with Bitcoin. I said, okay, great. What was their experience? Oh, well, they bought it and then it went down, then they sold it. And I said, well, no one ever told them to trade it. No one ever told them to trade it. And I think that's exactly where we are now. The oldest publicly traded Bitcoin treasury company is only 5 years old. We don't have any data. We don't have any data that's more than 5 years old. So if you can just zoom out, and if you're interested and you do your research and you decide you want to allocate, then maybe just allocate. For me, it's that simple.
Yeah, in investing or in trading, I'll say, nobody ever wants to buy when it's time to buy, right? Everyone always wants to buy when everyone else is excited about buying. And I think it's really difficult as an investor to retrain yourself to completely shift that, right? If you're waiting for consensus to build conviction, you're going to miss most of the opportunity that's there, right? That's what creates these scenarios where you buy in during these blow-off tops and you sell off when things drop back. I remember back in April when strategy went down to, what was it? It was in the low 200s, I think. And the noise on social media was that the entire strategy was broken. This would never recover. Nothing would ever come back. Everyone was selling out of their positions, right? It was a true capitulation event. And it was exactly the right time to buy. And that one stuck with me. And I remember it very vividly because we were in New York. And I think it was Pomp's event that he was having in New York at the time.
Yeah.
And you could just feel the energy. Everybody you would talk to it was over, right? It was, 5 years, but it was never going to come back again. And then it basically went straight up from that point on. So these shifts are going to be very normal. And when you're dealing with an asset that's volatile, and that's one of the attributes it brings that everyone was embracing during the times when it was going the way that they wanted it to, this is going to be a recurring pattern, right? Things are going to go way up. They're going to get frothy. That's going to create opportunities for people to make money on the way down. So some of the really sophisticated investors will deploy the strategies to drive these things down, create that cascading effect. You'll start seeing sentiment break. People move out of their position. It's how these cycles tend to go, which is why I actually think for a lot of people, a huge edge as an investor is not being on social media. Because when you're on social media, and particularly when you're in the worlds that we live in, right? Like you're bombarded with these things every single day. And when you're seeing it every single day, it's really easy in periods like this when everybody's turning negative on these investments and they think the thesis is over. It's really easy to find yourself in a position where you start getting frustrated and you go, well, is that true, right? Is it really broken this time? Even though if you sit back and you think through what it was that built your conviction around this, you've spent the time to understand the strategy, understand the implication of leverage over a long period of time, and that was why you placed the bets in the first place with these different companies, it doesn't change the way it feels when you're being bombarded with sentiment all the time, all day long. So for a lot of people, they can close their eyes, right? They make a bet on these things. There's people that probably bought MicroStrategy back in 2020 who haven't been on Twitter to see what's going on, and they just think things are going great, right? Going up to the right over a long time frame, things are going well. They're accumulating more and more Bitcoin, if I believe in the thesis of Bitcoin, right, it's going to keep driving that value in the balance sheet up. I think you have to regularly revisit your core thesis that first built your conviction, right? We've said this before. You cannot borrow conviction from somebody else, because if you're borrowing conviction from somebody else, the minute they change their mind, you're going to change your mind, even if fundamentally nothing has changed. Like, I look at what happened with strategy right now, and, initially I didn't particularly love that they were saying they were going to shut off the ATM, because I believe in keeping your optionality as a management team, right? You can choose not to use it, no problem. But I think if you give up your optionality, you're putting yourself at a disadvantage. But I think that there was enough investor noise that, that seemed like it needed to be addressed at the time. And now that they changed the wording in the way that Jeff said, to reopen that optionality for them to operate as a management team, to take advantage of events. They're not saying they're going to use it every week. Maybe they will, maybe they won't. I don't know. But when you do have things lingering on the outside, like a potential for S&P 500 inclusion, if that happens, you've got massive inflows that can be coming into the equity that you may want the ability to take advantage of. Right? It's not every day that you're going to have that type of liquidity coming into your equity. And as a team, you should be prepared to be able to take advantage of that opportunity if it arises. So I do think that when you evaluate these companies and you evaluate the management teams, you should be focusing on the way that they're talking about this, 3 years from now, 5 years from now, 10 years from now. Because if you want your management teams reacting to every shift in the market and every shift in sentiment, and traders that have expirations coming up at the end of the week or the end of the month or the end of the quarter, right? You can't have a management team executing a long-term strategy but reacting to short-term noise. That distracts from what you're trying to build and the value you're trying to create over a long period of time. And I think for investors, that's just something that you need to really focus on if this is a long-term investment for you. It's not to say traders can't be in the space. There's going to be tons of traders in the space because of that volatility. When these stocks are going down like this, there's somebody out there that's ecstatic about it because they're making a ton of money while this is happening. So you got to remember that incentives are different for everybody that's holding. The thesis is different, and everybody's reality starts with where their cost basis started, right? Your reality for how a stock has performed starts the day you buy it. So for someone that's been holding it for a lot of years, that thinks things are going great, continues to appreciate in value, for them, that's wonderful. But if you're the person that bought during one of these peaks, that's when your reality starts with this investment. So you've got a very different outlook. So it's all about, when you took on that investment, which is why it's important to be very selective with when you enter a position.
I keep thinking back to just the capital that they hold. And like today, there's a lot of noise. So I just try to shut it out and get back to the thesis, kind of as you outlined, Ben. And you just look at some of the numbers, and it's like super, super bullish. They hold $73 billion worth of Bitcoin. They have $6 billion worth of prefs. Let's just say composite 10% interest rate, $600 million annual obligation on the prefs. At today's Bitcoin holding value, they can pay 120 years worth of that dividend obligation. If Bitcoin falls in half, they can pay 60 years of that dividend obligation. We're talking about the year 2085. They can pay that dividend obligation until the year 2085. So it's just like they're sitting on so much capital, and you think about this kind of like credit quality of the company itself, and like that update to guidance doesn't really mean anything to me, because it gives them that optionality of continuing to raise capital depending on all market circumstances of like whatever comes in the door. Maybe there's a big block trade. Somebody wants to open a big block trade. They get an investor calls, and maybe they're not even short. They're just interested and they want to buy $200 million of the stock, and it's just easier to do it in a block trade via ATM, and they get it done. It's a simple transaction, and having that optionality to do that, I think is preferred. So yeah, I mean, a lot of noise when you could just sit on your hands here, and like the thesis is unchanged.
I was pretty happy to see them update their guidance today. And for me, it might seem counterintuitive when I make this statement, but the biggest risk that I see for strategy is not that they fail. It's actually that they don't have enough leverage, and that they're trying to get more leverage, and they're introducing these new perpetual preferreds, and they're using the ATMs. They're building this yield curve out. But the downside to them to me is that they just become the AAA plus rated issuer perpetually in this space. And that's not really like a downside as in they're going to go out of business. And this kind of gets into some of the conversations on Twitter this week about where different preferreds are in the capital stack and stuff like that, and pricing the different risks. And as I think about that, it's like, how would I price the different places in the capital stack right now with how their capital stack is built? And like, I'd have a very minor difference in yield between the different places in the capital stacks. I think of them as a AAA rated issuer, even though they're unrated because of how much Bitcoin they have. But as they think through building these things out, I like them actually being able to generate Bitcoin yield through common equity issuances as they're looking to grow these markets, because it might be that they're building out these different instruments and it might take a few years for them to explode. For whatever reason, they might be sitting at a 15-20% leverage ratio when they look post converts, they might want to be 40 or 50% leverage, and they just can't get that. And Bitcoin starts ripping, which delevers them, and they're sitting there and they're like, okay, how do I generate Bitcoin yield, increase Bitcoin per share? Well, the common equity is a great way to do it when you're trading at a decent MNAV in the meantime. And so I think it gives them better optionality, buys them time, and allows them to kind of figure out their space in the ecosystem. They're obviously the behemoth. They may not get to 40% leverage. I don't know. I think that's a thesis that is as untested at this point. But the flip side of that is that it's really hard to find a scenario where there's real credit risk to them. I think these guys have pristine balance sheet.
As fiat systems falter, wealth preservation isn't a strategy, it's survival. While the world reacts, Swan Private clients are already prepared. Swan Private builds strong relationships with clients around mutual conviction in Bitcoin's long-term promise. With concierge service, deep expertise, and airtight security, the Swan Private team helps build generational wealth the right way. Swan Private's comprehensive Bitcoin wealth platform serves over 5,000 clients with more than $4.5 billion of Bitcoin purchased to cold storage. Swan Private is built for long-term partnerships. Get started today at swan.com/private. Matt, do you want to touch on the gold revaluation or not reevaluating the gold situation and statements that certain people have made publicly?
Yes, there was a research article for those that didn't see from the Fed about potentially revaluing gold. Scott Bessent said it's probably not going to happen, but probably being kind of a keyword there. And so what does this ultimately come down to? Well, the gold on the balance sheet of the United States is valued in the 40 handle. I think it's like $42 or $44 a share or something per ounce gold. It hasn't been revalued for decades. So what would happen if they actually brought that up to a current market value? That's typically done to devalue your fiat currency. That's typically the reason. And so we've talked about on this show many times a bearish thesis for the DXY, the dollar relative to other fiat currencies. There's been chatter around if there were to revalue, it would be with the kind of a handshake agreement with China, and that there might be some reasons why both China and the United States would benefit from this. And I see that. I mean, you see President Trump's statements for years. He wants a weaker dollar. And so I think we're ultimately going to get that. And I think it's probably still right now not fully appreciated. I think probably in some of our circles there is more conversation about this, but in broader markets I don't think that they're really thinking about the potential for a revaluation of gold by the United States. But I think it furthers that thesis that the dollar is going to go short. And so this kind of even gets into a lot of different ways you could take this conversation. But even just when you think about Bitcoin treasury companies, if you have a thesis that the dollar is the weakest currency from a devaluation perspective, and you look at it from like an international perspective, the best way to be long Bitcoin would be versus to be short the weakest currency out there. And so if you actually are a believer of the revaluation of gold and that the DXY is going to go lower, that is a pretty strong structural advantage for US-based Bitcoin treasury companies over the years to come. And that it would probably offset cheaper interest rates in international markets. And so these types of conversations are ultimately going to be part of the drivers of what causes one Bitcoin treasury company to outperform the other over the long run. And they're really complex. And you have to really be smart on macro issues, different things that drive fixed income markets, interest rates, different exchange rates around the globe. But this is a lever that the United States has. And my view is that whether it's used or not, it's a strong signal of where the dollar's going.
So what's the logistics there? They revalue the gold and then what? Like what logistically happens? Like why would that make the dollar go down?
Yeah, so it really comes down to what is backing the dollar. Is it the faith and credit of the United States? Is it the military? Is it their tax receipts? Or is it gold? And to the extent that it's gold, the actual value of the fiat currency itself goes down because the dollar is not backed by gold, right? And so it's a mechanism to say, where is the value in the United States? And so obviously people don't really think about the dollar or the gold that the United States has as being worth $42 an ounce. They think of it as what it's actually worth. But it shows the government moving to weaken the fiat currency relative to commodities and to view where they're finding the store of value for themselves as a currency. It's kind of a silly thing. I mean, it really should just be marked to market. But the fact that they haven't remarked it for decades and that the Federal Reserve is writing papers about it, the Treasury Secretary is thinking about it, they're talking about it in conversations with China. You say, well, why are all these things happening? Why are different foreign nations buying gold? You're clearly seeing a move around the world for Federal Reserves and nations to stockpile gold. Also, you're starting to see it in smaller ones with Bitcoin as well. But those are symptoms of a weakening faith in fiat currencies and the dollar as the reserve currency status. And for the United States to take a measure in that direction would be a measure in support of that, not in contrast to that.
So it's a signal. It's like purely a signal that we want to increase the value of the gold on our country's balance sheet.
Yep. And my view is if this were to happen, for what it's worth, I think the initial reaction would be, if you think about gold versus Bitcoin, would be that gold's going to rip versus Bitcoin. But typically what you'll see is the opposite. And that you'll see, it's just kind of like when the Fed did QE, they bought treasuries, they bought agency mortgages, but in fixed income space, investment grade bonds, high yield bonds are what actually did the best during that, not what the Fed actually bought. And the reason was that what was being, in this instance, revalued by the Fed purchasing it, right? Treasuries and mortgages that would be revalued higher, created a demand out the risk spectrum. And in places where there was, relatively less liquidity, less size, it took less dollars to push the price up. And so risk assets did the best. And so my view is if the US government did this, you would see risk assets and commodity space outperform gold. Maybe not on initial move when it's announced, but ultimately I think that would be the catalyst when we go back to that gold Bitcoin chart that we talked about, that could just push Bitcoin up into an absolute bull market. And again, tying that back to Bitcoin treasury companies, if that were to happen, like long the Bitcoin treasury company that has the most leveraged exposure to Bitcoin in the most intelligent way. And it's going to be if you want to talk about the options trader, I think that's a scenario I'd be watching pretty closely.
And so all it would take is some agreement internally from the government and the Fed to do that. That's the government and the Fed, the two, the Fed being an independent body of the government, right? For those that are listening to this, I used air quotes. But yeah, if they wanted to do that and then potentially bringing in other
other nations, right? Like if you brought in China as well in that, and to do that in concert with them, or when China used to peg its currency pretty closely to the dollar, there's interest in not having that get too far out of whack. So it probably would be done, connection with each other, and it would likely be a weakening of the two of their currencies relative to other fiat currencies around the globe that would have less ability to be part of that agreement.
And for scale, that change in valuation is something like $11 billion going to what, $750 billion or trillion dollars? What am I looking at here? So book value, 11.04 billion, current market value about 750 billion.
Sounds about right.
Pretty big step up from that book value.
Yes.
Just a little bit. So do we think an inflationary environment in that circumstance?
Well, weaker dollar generally would be inflationary, right? You for things that you bring in, imports into the country become more expensive, so it's a generally inflationary phenomenon. But I kind of still go back to this. We've talked about trueflation, and trueflation not really showing big signs. Yes, CPI starting to rebound a little bit, but I think in this AI era, we're going to be in a pretty deflationary era. So I think it's a forward-looking move, and I think this is one of the things you're seeing from the Trump administration right now is they are trying to look forward here in this AI era of how do we position the country for strength over the next 10, 15 years as all these different things are happening. And I think that is the primary reason why I don't think that you do not hear them talk about concerns about inflation. You're going to fire Powell unless he cuts interest rates massively, right? We're going to talk about potentially considering revaluing the gold. Those are moves to say the concern is actually not about inflation, but the opposite.
So all eyes on Jackson Hole this week.
All eyes.
I might ask Ben Workman about another hot topic today, which is public companies publish the compensation of their boards, executives, and advisors. And I don't know how much of a reaction, because I wasn't on a lot today, but what was your reaction, Ben, to what some of the numbers are like compared to other similarly scaled or sized companies? And how do you think through that?
Yeah, I don't spend a ton of time on that. I mean, being a public company, a part of that is you're going to have transparency in the compensation of those public company executives, right? And so as more and more of these Bitcoin treasury companies become public companies, that's going to be new information that starts coming to light, and investors are going to have to look at that and, assess what those packages look like. I think there's always going to be an initial reaction to executive pay where just the general market always thinks it's too high by default, right? That's kind of the default stance out there. But when you look at these Bitcoin treasury companies, one of the things I look at is what you're actually hiring for is a very specialized skill set, right? You're effectively looking for people that can structure securities and raise capital, which is a very hard skill set to find out there, and that understand Bitcoin and that understand the strategy around Bitcoin treasury companies. So, I don't think people should be all that surprised when you see compensation that's maybe higher than what they expected it to be, because you are hiring for a very specialized skill set in these roles. And that's part of the reason you can have very small teams that can execute these strategies. So, there was a lot of noise out there, and, some of these companies have come out and there's some very interesting provisions in there, some of which I don't think are probably appropriate, but I'm not going to spend a lot of time highlighting those on here right now, but I would just say this is going to be an ongoing theme, right? People are going to look at these and they'll be able to compare these companies against each other. And over time, you'll see the performance from one company relative to another. And then at that point, investors can make their call on whether it was worth it to attract that talent or not.
A bunch of people made noise about Andrew Kang exercising options as well. He had options. Andrew Kang is the CFO of Strategy. He had options that had a $19 strike price, and he exercised them at $3.90. So the stock is 19x'd since he's been the CFO and he was issued these options. So I think he exercised $10 million worth of value, and the company made $12.7 billion last year. It's like Absolutely. The guy deserves
Like
it.
a good payoff, yeah.
Oh my God, the guy deserves it, right? Like I want him to be happy. I want him to continue doing what he is doing. And people were making a bunch of like, what does he know that it's like the guy made $12.7 billion for the company last year and his stock options 19x. Like let the guy get a new house. It's just crazy. There will be a lot of noise on this stuff.
I think it's kind of reasonable in my sense from people that have never been in a public company or been an executive of one to not understand what they're paid. But when you actually even look at this versus like, what does a random portfolio manager at an asset management company make, or what does a doctor make, or what does a lawyer make, and you compare some of these salaries, I think that they're super reasonable. And what you'll typically find with these companies is that they're using compensation consultants, and for the most part, they're probably trying to benchmark it around the mean and making sure that the incentives are aligned with the shareholders, where yes, you might get, general salary, a small bonus, but you're not getting the big payday unless the shareholders do really well. And then there's things around the edges that people can, disagree with. And, you look at some of these things, like it reminds me of, this is obviously early for Bitcoin treasury companies because they haven't proven themselves. But when Elon Musk got his pay package denied at Tesla, and you saw Elon drive so much value to Tesla shareholders, and then a random shareholder sues over the pay package being egregious. Well, Elon put it all on the line for for his company. He drove the value, and then it got blocked. And then ultimately Tesla leaves Delaware over this lawsuit. And so these are going to be, there's going to be criticisms of what various executives make in any industry. But I think, my view is that you can have a company that pays nothing, and you're probably not going to get a very talented team. You're probably not going to, outperform. You're going to want to have a Trumpa team that's going to be paid well, but it needs to be the right team, right? Like you could pay the wrong team well and they might underperform. So this is why you should really look carefully at the management, what they're doing, what's the position of the company. Are they going to be able to execute this strategy over multiple years? And if they are and they do, you should want them to get paid because they're driving shareholder value. And that is capitalism. And what you should not want is, massive paychecks for underperformance. And I don't think that most of these companies will do that, but time will tell.
Incentive alignment.
Yes.
Jeff, was there anything else on your list that you wanted to cover? Preferred liquidation preferences, issuer credit ratings, anything else on your list before we wrap it?
Let's hit on the preferred liquidation preference, because I think there's been a lot of noise on this recently about the preferred equities having this senior claim over the Bitcoin, which is, in my mind, a little bit of a misnomer, because it's really a senior claim over the assets on the balance sheet priced in fiat. So if there were any, so one of the things that's been happening in this marketplace is people are trying to conceptualize this moving liquidation preference. So as the price of the underlying preferreds go up, the liquidation price is I think it's like a 10-day average of what the price is. And this, I believe, is a technical solution to a technical problem of how taxes are treated when they ATM the preferred equity, the preferred equity. But a lot of people are construing this as the price of these prefs go up, they have a more senior preference over the Bitcoin held. But the reality is you have to think through a situation in which strategy would get liquidated. One, because they have the perpetual preferred equities, they don't have this debt maturity. So there's not going to be a situation where all this capital comes due at a future point in time. It'll be a function of them not being able to pay their dividend obligations and not able to raise additional capital. And what would be a scenario in which that happens? A scenario in which that happens is Bitcoin fails miserably. The value of the capital drops, 80, 90, 95%, and they have no ability to continue to go raise capital in the marketplace and go buy additional Bitcoin or pay the dividend obligations. So you think through conceptually what would happen in that circumstance. Well, the credit of the preferred equity issuance would fall dramatically because the value of the underlying Bitcoin has fell dramatically, and the value of that liquidation preference is $100 per share priced in fiat in dollars. So in the event that there was a liquidation, we're talking incredibly tail scenario here, all that Bitcoin would get sold into dollars and delivered back to the preferred equity holders in dollars, not in Bitcoin. So it's not a senior claim over the Bitcoin. It's a senior claim over the assets on the balance sheet priced in fiat. And I think that's an important distinction when thinking about the credit quality and how the structure of this capital structure is designed. Because there's a few people out there that are talking through crazy tail scenarios where STRF outperforms MSTR because of its senior claim over the Bitcoin, which it's only a senior claim over the assets on the balance sheet in the event of a liquidation. And I think it's a bit overblown. But that was this weekend's noise, and I think it was just completely disregarded after the MNAV revision of guidance. And I guess it's not an issue anymore. So we'll just move on into whatever this week's issue is, and maybe it's Choose Rich deciding to talk crap about strategy from his condo in Florida, where you could probably pinpoint his exact location. And I'm sure somebody knocked on the door and said, "Hey, don't talk bad about Michael Saylor. He's right down the street. He's like big, bulky guy." Who knows? We'll see whatever the future FUD is, but it's getting pretty ridiculous out there.
See, those videos made me laugh. I like to be entertained as much as the next guy. And, when he's doing the reading of, the legal read, that made me laugh. So I could appreciate comedy when I see it,
Spitting on his camera.
Yeah. I mean, there's always going to be engagement farming, right? I mean, that's social media. So there's a lot of people out there trying to garner views and likes and comments and all that. And, one of those is the fear concern, right? They're coming out as concerned citizens, and they're drumming up fear responses in people and getting engagement. But the videos that they made me laugh. So, I at least got a chuckle out of those. But it is all these things, right? I think it's easy to react to them and, just get dismissive and go, why bother focusing on that? But I will say that a lot of these conversations, regardless of, how well-founded the arguments might be on them, it does at least force people to go and learn more about each of the specific products. And people are learning, this whole pref discussion, people are learning about, the difference in the capital structure and when those clauses actually become effective, and whether this is more of a contractual arrangement versus an actual claim to something. And I do think that in the end, it all becomes net positive, and we're going to shift in and out of these phases continuously. And, this week it's, prefs and liquidation events, which, quite frankly, I'll say if I'm making my investment based on what happens when it liquidates, I should probably be in a different investment. I hope that's not, the way that a lot of these portfolios are being structured, but maybe. But I think that anything that drums conversation, if it becomes productive, is good. But there are a lot of times, and this is just social media in general, where it devolves, right? And you get kind of that horde mentality where people start piling on and deciding that one answer is the right one, and it amplifies that message in a really big way. So now everyone's seeing that one because it's getting the biggest response out of it. And you've just got to temper what you're seeing. Be willing to sit back and assess this for yourself and question, what's real, what's not real, because, ultimately you're responsible for your own capital allocation. Nobody else. Nobody else should be able to tell you what stock to hold. Nobody should be telling you what to pick if you don't have conviction and you are your capital allocator, and it's not a financial advisor putting you in a diversified portfolio and they're responsible for it. If you're making the choice to, click the buy button, you need to know why, and you need to know what your thesis is, and you can't borrow that conviction from others, because if you do, this type of noise is what's going to cause you to question it and make a reactionary move that might not be the right one for you. And you've got to live with that as well. So, that's why we've said for a very long time, right? Research can be a team sport, but investing is an individual sport, and if you're allocating your own capital, you've got to be responsible for the good outcomes and the bad outcomes. So it can all be productive. I would urge people to try to keep it productive to the extent that they can, not get too wound up in the emotions and the knee-jerk reactions, because keep in mind, just 2 weeks ago, everyone was over the moon. We had an amazing earnings report that had come out. They went through that whole presentation. It was an amazing display of engaging with the investors and bringing them into that earnings call, and people were really pumped about the future. And it doesn't take very many trading days for that sentiment to shift entirely the other way. So you've got to ask yourself, has something fundamentally broken here that changes what my opinion was just a few weeks ago? And what is it that changed? Have I seen anything that actually changed, or have I just heard from somebody else that in their eyes something has changed? And you need to decide that for yourself.
That's a great point. That was 2 weeks. What was that? Two weeks ago?
I think 2 weeks. Yeah, two weeks ago, 3 weeks ago. Not very long, right? But
Jesus.
we're in that age. Information flows incredibly quickly.
Yeah.
And that means that, sentiment's going to shift on a dime. And Bitcoin price can come down, or one of these treasury companies' price can come down, and that's going to immediately pivot that sentiment. And if by the end of next week we're at 430, he's going to be, brilliant again, and people are going to be on board. It's how it goes, right? These things go in waves, and it does get tough, to, manage and police your emotions, but you have to, so that you can keep yourself in the right position if it's truly the long-term vision you believe in. And if nothing's changed about the long-term thesis and this is just the noise of the week, then you go outside and you start touching grass again. Go enjoy life for a while.
And my biggest takeaway on the executive pay conversation and this moving pref liquidation conversation over the weekend is that retail investors are reading SEC filings on a random weekend. And so like, I love that. I love the debate. Like the reality is probably there's never been a time in history where retail traders were so, interested in what was the content of these filings, debating them. And it gets heated and overly heated sometimes. But if you just take the step back and say, this is such a good thing, and the knowledge that this retail base is getting, that frankly, like most institutional investors don't even have specific, they definitely don't have on the Bitcoin treasury companies, that knowledge is going to compound over and over again every single time these new things happen in these filings. And it's why there's an opportunity here. So I think it's on one hand, it could feel, frustrating. And sometimes, you have different time preferences, everyone having their different, way that they look at the world. But it's pretty awesome that's where we are as an investment community is reading over the fine details and who's taking private jets or who's how do these things move and like why are they moving and liquidation preferences and understanding it, because I do think that like if you're on the outside looking in and you read these things, it may not be clear like why these things happen. And if I was just an average retail investor, like my first question on that would probably be one that once explained to me, I'd be like, oh, that makes sense, but it would not be intuitive.
I view these very much, if you look at human nature around sports, I look at it very much the same way, right? People start they pick their team, they start rooting for that team. And then you get, in this case, it's a week, but, for a lot of these, all of a sudden you get a couple of games where they start losing and sentiment shifts entirely and you're never going to win another game and this team sucks and they need to replace everybody on the team, right? It's that mindset, but it's coming into investing now. You've got the same thing. People are picking their teams and you're getting those shifts in sentiment, but you're right, Matt. I mean, this is a really, I would say, important shift for a lot of people to be able to actually take the time to go through the level of information that's out there. I don't think most people knew what kinds of filings were out there for any public company. So now to be able to have access and understand what each of these filings is released for, read through the information, and even if you don't spend the time to learn about all the different filings, just knowing they're available, knowing where to go find the information is a huge advantage that people are getting now. In this space, because of the speed of information and the openness of the information that's out there, has been one of the best learning grounds because you get to constantly refresh that knowledge over time. And sometimes that's what you need, because you can lose sight of information that came out and you need to be reminded of things as time goes on, because as we've all learned, the space moves really fast. But it is a pretty cool shift to see retail investors starting to get that engaged at that granular of a level around public companies.
We're not wrong. We're just early. And we're in this attention economy where you can get a toothbrush delivered to your front door in 4 hours, and people expect, monumental business ideologies across the globe to shift in the same time period.
Oh, we want a decade of execution in a month, right?
Yeah.
I mean, that's kind of the mindset you get into ultimately. And you have to remind yourself, right? These companies are trying to execute on a long-term vision. You're trying to build towards a future, and you need to keep the goalpost at that long term so that you execute and you keep your focus on that outcome, right? You can't get distracted. You can't have a management team that's chasing left and right based on what's happening every single week. You need to know what the goal is. And when the investors know what the goal is and they understand what it's going to take to get there, you can be patient because that's where long-term value is delivered. How many of those stories do you hear about the people that buy, Amazon stock or Apple stock or, pick your successful company, and they just forgot about it for a decade, and all of a sudden it's worth huge amounts of money, right? If they were watching price action every single day and, changing their mind every week, you'd trade your way out of those positions because all those companies have had their periods of time where sentiment shifted on them and people thought that they'd had their run and it was over, and they've continued on. So I think it's very much going to be the same here.
It's kind of like Bitcoin itself. Well, Bitcoin's dead again. Oh, nope, it's not. It's not. Wait, it's not dead. Well, thank you everyone for listening, watching. For Jeff Walton, Ben Workman, Matt Cole, I'm Tim Kotzman. We're here weekly with the good, the bad, and the funny here on The Hurdle Rate. Thanks for joining us.